Welcome to This Explainer. Today, we're going to take a messy, chaotic business and turn it into an absolute masterclass on accounting. We are looking at how a simple street stall scales up, and to do that, we're following the story of Raju's Pani Puri Center. He's growing super fast, and as we'll see, the old ways of keeping track of his cash just aren't cutting it anymore.
Okay, here is our roadmap for today. We'll start with Raju's expanding business, then we'll dive into the power of cash books, special purpose books, and the ledger. After that, we'll walk through a typical day in Raju's life and finish up with a chapter summary.
All right, Section 1, Raju's expanding business and those inevitable growing pains.
So imagine this. Raju is accepting UPI payments, he's fulfilling VIP bulk orders, and he is literally drowning in one massive book. Every single time he sells a plate of pani puri, pays rent, or buys a sack of wholesale flour, it gets crammed into this giant, overwhelming journal. Sure, it's chronological, but trying to actually analyze it? Forget about it. It's a total disaster. But then his smart assistant, Chotu, steps in and suggests something brilliant. Split it up into smaller, colorful sub-books called subsidiary books. And honestly, Chotu hit the nail on the head.
Moving on to Section 2. Let's look at the first tool in Raju's new arsenal, the power of cash books.
The cash book is entirely dedicated to cash receipts and payments. But here is the secret superpower of this thing. It actually serves the purpose of both a journal and a ledger. It's a total game changer because it eliminates the need for a separate cash account in the ledger entirely. Think of it as Raju's daily cash box, just in written form. Money comes in, that's a debit. Money goes out, that's a credit. It's simple, direct, and incredibly efficient.
Now, what makes this tool really cool is how the double-column format perfectly handles both physical cash and modern bank or UPI payments side by side. Raju now has a specific column for cash and another one for bank. So when a customer scans his QR code to pay for a VIP catering kit, boom, it goes straight into that bank column. It brings a classic accounting concept right into the modern digital age.
But wait, what about the really tiny things? Raju shouldn't be interrupting his whole workflow just to record a 20 rupee purchase of cleaning cloths, right? For those tiny daily expenses, Raju sets up a petty cash book for Chotu using what's called the Imprest System. Basically, it's a definite sum given to a petty cashier for a set period, and then it's reimbursed exactly as it's spent.
This is such a brilliant way for Raju to keep control of his funds without micromanaging every single bunch of coriander Chotu buys. Here's how it works. Step 1, Raju hands Chotu a 500 rupee note. Step 2, Chotu makes all those little miscellaneous purchases throughout the week. Lemons, coriander, maybe some bus fare. Let's say he spends 400 rupees total. Step 3, Raju gives Chotu exactly 400 rupees back. Why? To restore that original 500 rupee balance. It creates this perfect loop of accountability.
All right, Section 3, Special Purpose Subsidiary Books. We are in the big leagues now.
Since Raju is a big player now, he's dealing with bulk orders and credit. So we've got to separate those massive daily transactions into their own dedicated lanes. First up is the purchase book. This is specifically for recording credit purchases of goods meant for resale, like when Raju gets 50 sacks of wholesale flour from Lala Provisions on credit. Then there's the sales book, which records credit sales to his customers, like those VIP office workers who pay him at the end of the month. By splitting these up, Raju instantly knows exactly what he owes his suppliers versus what his VIP office workers owe him.
Let's test your accounting instincts with a scenario that honestly trips up almost everyone. Ready? Raju's business is booming, so he buys a brand new stove on credit to expand his cooking capacity. Does this transaction go into the purchase book we just talked about? Think about it for a second.
The answer is a resounding no. Credit purchases of assets go in the journal proper. This is a crucial point. The purchase book is only for trading goods, the actual things Raju intends to sell, like flour, spices, and potatoes. It is not for long-term assets, like a new stove or a fancy chair for the stall. Those always go into what we call the journal proper. Do not let that common trap catch you.
Now, what happens when things go sideways? Let's say Lala Provisions sends Raju a batch of rotten mint leaves. Yuck. Raju isn't going to pay for those. He sends them right back. To record this, he uses a debit note, which is a document raising a debit against the supplier, and he logs it in the purchases return book. On the flip side, if a VIP customer returns a defective catering kit, Raju issues a credit note and pops that into the sales return book.
Section 4, the ledger. This is the final destination.
Think of the journal and the subsidiary books as the travel phase. They capture the transaction exactly as it happens, chronologically. But the ledger, that's the home phase. This is analytical posting. Picture the ledger as a big T-shaped house where every single person Raju deals with gets their own dedicated room. Lala Provisions gets a page. The VIP office block gets a page. Everything is finally sorted by account, not just by date.
And why do we go through all the effort of moving data from the subsidiary books into this ledger home? For this exact concept right here, balancing the account. At the end of the month, Raju totals up the debit side and the credit side of Lala Provisions' ledger page. By finding the difference between those two sides, Raju finally answers the ultimate question. Does he owe money or is he getting paid? It gives him total clarity on his business's health.
Let's move to Section 5, a day in Raju's life. Let's put it all together. Let's break down 5 actions on a chaotic Tuesday and find their perfect homes. First, Raju pays his stall rent via UPI. That's a bank transaction, so it goes straight to the bank column of the double-column cash book. Next, he buys flour on credit for his daily prep. That's trading goods, so into the purchase book it goes. Oh, wait, some of that flour was stale, so he returns it. That hits the purchase return book. In the afternoon, a VIP office orders a bulk catering kit on credit. Sales book. And finally, his back is hurting, so he buys a new chair on credit. Remember our trap from earlier? It's an asset, so that goes to the journal proper. Notice how every single business action instantly finds its perfect home, keeping Raju's empire totally organized and stress-free. Finally, Section 6, Chapter Summary and the 7 Keys.
Let's quickly wrap up by reviewing the 7 specific books we've mastered today. Number 1, the journal for original entries, like those assets. 2, the cash book for all money moving in and out, physical or digital. 3, the petty cash book for Chotu's tiny expenses. 4 and 5, the purchase and sales journals for credit transactions of trading goods. And 6 and 7, the return books for both purchases and sales when things don't go according to plan. Utilizing these 7 tools is exactly what elevates a business from a messy single ledger into a highly scalable, professional financial system.
Accounting isn't just about memorizing textbook rules. It's about organizing reality. As we saw with Raju adapting to UPI and bulk orders, the system has to reflect the actual business. So as your own future business scales and evolves, how will you organize yours? What unique subsidiary books will you need to invent to keep up? Keep that in mind, keep learning, and I'll catch you in the next explainer.